There are many paths to wealth, and all of them are risky. If you ask any rich person, all of them did it with some amount of risk, right? You can either go like the slow route, for example, save in the 401k or so, but then you would often need decades to build significant wealth that would make you financially independent. If you look at any person who became financially independent quicker, they took on more risk. For example, they created their own business, which is highly risky. If you create your own business, you might have like a 95% failure rate or so within the first, say, 5 years. If you invest in individual companies, you could lose everything if the company fails. Stocks are just businesses, and businesses have a high failure rate. If you invest in the S&P 500, you are not at risk of loss through insolvency of individual companies, but you still have market risk, and your growth rate will be much smaller. You can also build wealth by investing in cryptocurrencies or speculative assets, but obviously these are also risky paths. Generally, I think there are mostly two, maybe three ways of building wealth. The first one is to buy investments and wait for the investments to appreciate, and then maybe sell them, maybe keep them. In this case, investments would have to appreciate. The second way is to create your own assets, like with your hands, with your mind. You can create an online asset. You can create an offline asset, like a house. You can build a house yourself, or maybe you can combine it, like investing some capital into a house, fix it up, and sell it at a profit, or keep it at a profit and rent it at a profit. But no matter what, you need to either invest or build new. This is not financial advice. I'm just doing some math and financial modeling. I'm doing this for myself because I consider these things on a daily basis, and I just share my own analysis, right? So I don't recommend anybody doing this, and nothing in this video is investment advice. It's just education. Okay, so let's dive right into it. Say somebody is an average income earner, like for example, a US government employee. They make, I checked PayScale, Glassdoor, Indeed, Salary.com, and we get salary ranges from 40K to 109K annually before taxes. So if we take the median income, it would be 69K. I put in this number into a tax calculator and get out the take-home pay of 56K. So this is my assumption now for somebody who is seeking wealth but wants to keep his government job, right? Has an like average income of 56K. I wanted to check how easy it is for this person to build significant wealth with a leveraged stock investment strategy. And I use the example of a company. Let's go to the company. The very obvious company is Google, right? Here we see the Google price history 10 years ago. Over a period of 10 years, we have seen not so significant price appreciation, like it was maybe a 4 to 5x or so in 10 years, which is not significant. So Google already was. It's not hard to see it. It is not an instance of hindsight bias, right? Because Google was very obvious to many of us in the technology space. It was obvious even to the common man, right? It was already a $500 billion market cap company in 2015. It was already a monopoly in search. You can see in all company rankings of tech companies, you would see the name Google. It was as obvious as, say, Meta or Amazon or something like today, right? So these kind of, it's still obvious. It was one of the biggest tech players with a monopoly, with a very robust business model. We were already seeing AI very clearly. Google was the AI leader. So this is a bet. Like I would say if you invest in Google today, you probably would get the same 4 to 5x over 10 years. So I don't even see diminishing returns here, or even like a problem in any way of hindsight bias. Okay, so let's look at the assumptions. The assumptions are 56K net income after tax, as I already said, and 20% savings rate. This is absolutely possible. And this savings rate would be in addition to a 401k retirement strategy. So if all the money in this separate portfolio were lost, the person would still have the 401k, the retirement strategy would still have the government job, would have lost 10 years of savings. As I said, there's no return without risk. And even creating a business, maybe giving up the government job, creating their own business would be far more risky strategy than investing in the global monopoly for search and one of the leaders in AI. Investing in a global company is even less risky, in my opinion, than investing in, say, your own real estate in a highly leveraged way. Because investing in real estate is always a leveraged bet. Almost nobody buys real estate with cash on hand. All of them buy with significant amounts of leverage. And we have seen very often in 2008 and other periods that this leverage can turn out to be a very, very high risk bet as well. And in my opinion, it was even higher risk to take on leverage to buy real estate than it is to take on reasonable amount of leverage to buy a global corporation, one or more of those corporations. And this strategy basically doesn't, like, it's not an advertisement for Google or anything, right? I'm not even telling that Google is the best play here. We have many videos on discussing not only Google, but also Nvidia, also Tesla stock on the Finxter channel. And I think many of those companies would have the same return characteristics. This is not dependent in any way on the Google investment bet. Okay, so let's dive right into the strategy. The first strategy is just to accumulate Google shares using these assumptions I outlined before. So we buy for 11K every single year Google stock. There's no leverage involved. And you see in blue, we see the new Google shares over time. And in red, we see the cumulative Google shares. So we simply accumulate Google shares. No matter if the price goes up or down, we just buy new Google shares as we get the money in our retirement account. Can I make this bigger? Great. We end up with 2,000 shares in the end. And today, at today's price, per share price, we would get a total investment in assets of 354,000, right? So we put in 112,000 cumulatively, and our assets are now worth 354K. So we have made like a 3x or so on our capital, which would already be like a significant chunk, right? If you are, I would say, like a mid-level income earner, like we assumed here, this could already be enough to semi-retire, right? Maybe you have one or more income streams on the side. Maybe you half your income from a job or so, and the other half you use your investment assets. So it could already be enough for semi-retirement, depending on the concrete situation at hand. Okay, but let's look at a more aggressive strategy. I wanted to do the math for adding unsecured debt every single year to buy more of those high quality assets, like high quality tech stocks. How is this possible or even reasonable? Government employees have access to capital, right? They can often take loans at very good terms, often interest free. Sometimes they get low interest. I don't even assume low interest rates. I assumed like a 5% interest rate, and a loan, a 20K business loan that is paid back over 5 years. So we have 4K loan payback every single year until after 5 years we are debt free. After 5 years you have accumulated 5 such loans, but of course you don't spend the money. The person assumed in this slide would pay back their loan after 5 years. So after 5 years they would have accumulated 5 such loans, partially paid back already, and in the 6th year we would have paid back the first loan, and we would still be at max 5 loans. So it is a reasonable strategy. There's some unsecured debt involved. Unsecured means you don't post your assets to get the loan. Right? You just get the loan because you maybe have a good credit score, you have a good income. Basically, your biggest asset as a government employee is to have a fixed and predictable and reliable stream of income from the government. And banks love this. Banks give out money to employees with a very safe and predictable income stream, because they can always calculate whether you would be able to pay off the debt. And there's good debt and there's bad debt. And as we all know, the good debt would be to purchase assets from the debt. The bad debt would be to purchase liabilities. So we have all read Kiyosaki's Rich Dad, Poor Dad. I hope so. This strategy, what would be the modeling? Here we assume Google prices from year 2015 to year 2024, Google prices of $26 to $177 today, and the income of 56K. We don't assume that the income can grow or anything. We just assume a flat income for simplicity. We assume a savings rate of like roughly 11K and assume new loans of 20K every year. Small loan amount could also be like, you can also take one big loan in the beginning or something. It could be like anything. These are just the basic assumption in the spreadsheet. And here in this column, we see the debt outstanding. So we accumulate the new debt. We have like a debt outstanding account in the balance sheet. This would be your liability side. And of course, you don't have only liabilities, you also have assets. This would be the asset side. So at any point in time here in this scenario, backtesting the last 10 years, we would have more assets than liabilities. So it's a basic business strategy that could be done or repeated by any employee. We see the interest. There are some interest expenses, loan settlement expenses, and we would pay those expenses from the newly issued debt, and the remaining we just put into new Google shares based on the debt and the cumulative savings. We basically buy Google from the savings plus the new loan minus the interest minus the loan settlements, because these are our expenses. So we don't assume there's coming any fresh money right into the system from yourself or even a higher savings rate. We just assume, you have your old savings rate, you purchase the assets, but then in addition to that, you purchase the asset from the debt, and you simply take this 20K new loan every year. So your debt outstanding will never go beyond, say, 90K or so, because you will always pay off the debt from new loans you take, right? And but your asset side hopefully will keep increasing because you purchase more and more shares, and the shares should go up as well if it is a profitable business you are investing in. This is a spreadsheet, so let's have a look at the outcome on a visual chart. Here we see in red, we see the investments. The investments grow from 0 to 568K with this simple, slightly more aggressive strategy. And basically the liability side of the balance sheet would be 89K. Yeah, so we have 89K against 568K. And we will see an overview of the different strategies in a minute. But let's check out the most aggressive, not generally recommended strategy. This is to buy on margin. So to use the previous mildly aggressive strategy, plus going to a broker, any broker really that offers. There are many brokers, like I would say the biggest American US-based broker provides this strategy as well. So you put your assets there, you purchase the stocks at this broker. So the stocks are basically living there within this company, and which means that they have control over the assets. And having control over the assets, they allow you to get a loan to post your assets as collateral for a margin loan, and you can get a 30% margin loan against the assets and reinvest this into the shares you are accumulating. And we assume a 5% margin loan rate, which is like very conservative. Given the last 10 years, we have seen margin loan rates that are much, much smaller. So this is like an average margin loan rate, more on the conservative side. How would this strategy have performed in the last 10 years? So let's have a look. This is just the outcome. We accumulate the total investments here in red. You see sometimes the investments also go back. If you have 30% margin loan against those assets, the asset value goes back. Basically, our loan becomes too big, so we need to sell more Google shares to get back to this 30% loan to value, right? So this is a general problem with margin loans. If you take out a margin loan and the stocks you have posted as collateral go back, then the loan to value goes up, right? Because relatively your loan doesn't go back, but your value goes back. So the loan to value increases, but it is not allowed to go beyond, say, 30%, sometimes 50%. If it goes beyond this threshold, you basically need to post additional assets, or you need to sell assets in order to bring down your loan to value to the allowed amount, right? And this happened in this 1 year here, where the price of Google fell we needed to sell Google shares, which would then reduce our total holdings of Google shares. So so we had this worst case scenario here in 1 year, and we got negative shares through the margin loans over the years and the growth of the asset. Remember, if the assets grow net organically, the loan to value goes down. So in the next year, you could purchase additional shares from the remaining margin allowance, right? And you would purchase those shares year after year, and that's why you would have accumulated much more shares than you would have sold here in this year where it goes back. And overall, it was a profitable strategy. You would have made 861k in assets and 264k in liabilities. So your net assets is roughly 600k in this scenario. Okay, so let's have a quick overview. This is basically the slide, the different scenarios, backtesting the different scenarios for Google. It would have be similar for Apple and other tech stocks 10 years ago. Strategy 1 is DCA, just buy the asset and hold it for a long period of time. You have zero risk in terms of losing all your capital. There would be volatility. The stock you're betting on could go down, obviously, but apart from that, there's no debt incurred risk, right? Because you have zero liabilities. So the net assets would be 354k. I would say this strategy is less risky than buying a house on credit. Many people would consider this a risky strategy. We need to agree that buying a global corporation like Google is less risky than buying a house at a single location where the demand for this location could drop significantly over a decade or so, right? And also the house could burn down. I mean, the Google factory could also burn down, but they would just build a new one, right? They still have the brand and everything, the brand name. It is a much stronger asset, Google stock, than your own house. Even though it doesn't feel tangible, it is much stronger asset. And you don't have any liabilities against this. So in the case of your house, even if the property price goes down by 20%, many would be underwater. If you have a fully financed home and it goes down 20%, you basically lose all your equity. So it's a much more risky strategy to add liabilities to buy a real estate than just buying a global monopoly. The third strategy is as risky as buying a home fully financed on debt. Buying a home, by the way, is not an asset because it doesn't give you any cash flow. It's just consumption in a way. But the home price could appreciate and you sell at the right point in time. So you could also maybe build some equity with owning a home. But it would be probably difficult to build 600k in equity, right? Even if you put 11k in your home every single year, it would be difficult to build that kind of wealth. The second strategy is to add unsecured debt to buy more. This, as a government employee, your biggest asset for the banks is your reliable income stream. So it is possible to take on some smaller loans, but don't consume the loans, purchase assets from those loans, and let the assets appreciate faster than the loans appreciate, and always maintain a healthy loan to debt or assets to debt ratio. And the third strategy is to add additional margin loans, like a loan to value of 30% or less, to buy even more assets. So your asset sides grow, but also your liability side grow. And it is an even riskier strategy. And we see that our results go from 354k back tested on the Google stock to 479k to 596k. You might get a 2x return for the added risk of the capital loss. For most people, obviously, strategy 1, the low risk strategy, just buy and hold, don't incur any liability, would probably be the preferred method to do it. But as I said multiple times during the talks, I also think there's something to be said for strategy 3 or even strategy 2, because your assets always are much larger than your liabilities, and you could keep it that way, right? You could at any point, if the value of the assets drop significantly, you could always have your own stop loss set up so that you would get maybe your initial investment back or something. It could always be done to set it up in a way so that your maximum loss is kind of limited to to what you put in as investment over the years. So yeah, to be on the right side of change, I think this is the biggest takeaway. We need to focus on the asset side of the balance sheet. We need to build our own assets because the global economy is capital plus labor. It consists of capital and labor, intelligent labor, is getting scaled right now. It is becoming a commodity. So more and more of our tasks that we do for our job get automated. Our jobs might still exist, but they will look very differently. And over time, AIs could even do like the new job that would be replaced. It can go really quickly, and we already see it everywhere. I already feel it. I already talk to many people myself who feel it. It is very obvious to most of us that from the economy being capital plus labor, the labor side is getting scaled up. It's getting scaled up to infinite, right? So we will have infinite labor. So the relative value of your labor as a human being who cannot scale their days beyond 24/7 is getting depreciated. And all capital, basically, if you think of capital as being distilled labor, the capital assets will increase significantly in the future. Capital is still scarce. We can build new capital, but this just means that the value of the existing capital assets will just explode, right? If you have scarce monetary goods or companies producing the disruptive technology like Google or Tesla or Nvidia, building the robots, building the AIs, they will benefit significantly from the appreciation of capital of labor assets. And if we want to be on the right side of change, we need to focus on accumulating or building more of those assets. And yeah, in this video, we looked at 3 strategies to do this aggressively as a government employee, becoming financially independent. Again, this was not financial advice. If you like our education, then check out the free Finxter newsletter. Just go to finxter.com and subscribe. I release some interesting tips and tricks to be on the right side of change every week, sometimes multiple times per week. And yeah, we also have like a paid membership. This is how we keep the lights open, how we finance everything, how we keep the community of 160,000 people on our list engaged. It is the Academy, the Finxter Academy, and for a small annual fee, you can basically check out all courses on the Academy. And the courses are expert courses on building the new AI environment that we all anticipate, right? For example, we have courses on building multi-agent teams and systems using LangGraph. We have courses on fine-tuning OpenAI models, on building generative AI applications using Google's Vertex AI and LangChain tools. We will soon launch a course on Hugging Face. If you are in the AI space, most of the open source models are hosted via Hugging Face. You can access those models using Hugging Face infrastructure. So this is like a beginner course on Hugging Face. We add more courses over time, but if you're a Finxter Premium member, you can access all courses, and the membership is not expensive. You can also become access all the courses by becoming a channel member. So subscribe to our channel, and then in addition to subscribe to the channel, which is free, you can also get a paid member. If you join a Tech Katana level or above, you also get access to all academy courses. Thanks for listening to this video, and yeah, I hope to see you in the next video. Check out our links, check out the Finxter ecosystem. Our mission is to keep you on the right side of change. I'm grateful to have you here. I'm grateful that you have invested your most scarce resource, your time, into listening to this. And yeah, consider these strategies to build wealth. This is not investment advice, but I think it could be interesting to do those type of calculations yourself and think for yourself. Like, don't just repeat what everybody is telling you, like your house is an asset or something. Yeah. Oftentimes we need to purchase higher quality assets like global tech monopolies. Even incurring some amount of liabilities could still be a healthy and sustainable investment strategy. Thanks for watching this video again, and see you